Almost forgot the music. All right, enough of that. Enough of that. How you doing, friends? Good to see you. It is now Wednesday, July 19th, a little bit past 3 o'clock. This is the Final Hour Show, episode number 43. Season 2, by the way. Not just episode number 43, but something like 150 episodes so far. The first season, we did 100 trades where we would trade the very final hour of the market. And that was mostly a both up and sideways type of an experiment. So this season, what we're going to do is a little bit different, examine a number of different strategies that could be valuable in a zero DTE event. So what is zero DTE? That stands for 0 days to expiration. That is the final day in the life cycle of an options contract. Now, why do we trade zero DTE? Well, if you know anything about options, they have two primary components to the value of that option. One is their intrinsic value. I was just reading the first comment that came in. That's the intrinsic value of the option, and that is the difference between the actual price of the market and your strike price. So if it goes in your direction and there's a big difference between there, you make a lot of money. And there's a lot of leverage involved there, so that's really cool. If you're choosing to go the other way and it goes beyond your price, great. If it doesn't make it to your price, then you're a big loser. That is, if you hold it to expiration. Now, there's another component that I didn't talk about there, and that is the premium value. Now, premium, if you're buying options, premium is not your friend, because premium is working against you. It is constantly decaying. So a portion of the value of your option is constantly decaying. Now, over the life cycle of an option, that decay can be not a problem if it were in the very first part of the life cycle. That's because the premium decays at a very, very slow rate initially. And then as you get closer and closer to the expiration of the option, it starts decaying faster and then faster and then faster until it's falling off of a cliff on the zero DTE day, where it is decaying at its fastest rate in the shortest period of time. You think, okay, so how does that benefit somebody who's trading? Well, it certainly doesn't benefit somebody who's going long an option. But it will benefit somebody who is setting up a strategy that collects that premium. Now, there are a number of different ways to collect the premium. There's the most pure way, and the most pure way of doing that is by selling an option and then collecting that premium. And that decay that happens at an exponential rate, and it happens on that zero DTE at an incredible pace in the shortest amount of time, is where you want to be. That's primarily your edge as a zero DTE trader. Now, there's a lot of problems with just selling an option. In order to be inside of that tent, that profit tent of a single option, well, you have to be pretty right. You have to be right on, either you get very, very close to the money and then you hope that the premium or the price ends up right there and doesn't go against you, then you can collect it. That's fantastic. But if you're not right there when price ends up at the end of the day inside of that profit tent, then you're going to be a big loser. So how can I demonstrate this? I can demonstrate that simply by going to the charts. And so that's what we're going to do, because we are a whiteboard type of service here. I'm going to set it up for you, show you exactly how this works. There we go. There's the whiteboard. Now, this was yesterday's whiteboard, so we need to start a new whiteboard. And as you can see, we do a lot of whiteboards here. There's a lot of whiteboards, It just goes on forever. You're going to learn a lot here. Just hang on. So we'll create a new screen, and we'll take a look at something called the risk graph of an option. Now, the way most people play premium collection is with what's called a naked put. That's where you sell a put. Now, when you sell a put, that's a directional trade, more or less. It's saying that you're bullish on the market. You hope that price stays about the same or goes in your direction. Now, let's take a look at what that looks like. Let's first draw the risk graph. So this would be plus, this would be minus, and this is your zero line. And let's say that price is right here. Now, when you put on a naked put, you're selling a put. And when you sell a put, it's going to look something like this. Now, let's say that the strike price that you want is right at the money, right there. Well, it's probably not the best way to do it, but your risk graph is going to look something like this. So you're going to be sitting outside, and you need to get inside here, because that's where the profit lies. So that means that you need price to go this way, bullish a little bit, until it gets to a point where it's break even. This break-even point is the point where you overcome the debit or the cost of your trade, or the risk. Maybe that's the better way to put it, the risk. Now, it doesn't actually look like this. I was doing a spread. Looks like that. All right, there's your risk. Now, the premium, when you first get into a trade like this, is going to look something like this. All right, so the cyan line is your intrinsic value. The magenta line, that's your extrinsic value. So when you get in, what you're hoping for is that you're going to move into your profit tent, and you're going to make this right here. Of course, if you're outside here, you're not going to make anything. So this is like a no-go right here. So what you want to do is you want to take that trade when you're inside the profit tent. So a trade like this should really be set up like this. You want to start on the inside and take a strike price out here, right? Because if you take a strike price out here, now your profit looks like this. So now, as a seller of this put, this is a short put. Eventually, what's going to happen is this premium line is going to decay and then turn into this at expiration. This is the contract terms that you have in a put. And so you're sitting right here. It's also your real-time profit line. So if price goes up or goes down, you follow that purple line. So let's say price goes down to here before expiration. You're like 10 o'clock in the morning. You're down. You're in the negative, maybe down $100. If it moves up, you're up. maybe $100. Now, if you're lucky and you stay, say, here or anywhere inside of this point right here, the break-even point, this line is going to continue going up, and that represents your profit until it fills up here. And then if you stay inside, you could potentially make that full amount. Let's say it's $500. That's great. That's selling a put to ensure that you're going to make some money by either going down a little bit, staying the same, or going in this direction. So you make money whether you go this way a little bit, but you also make it if you just stay right there. So that's pretty cool. Now, there are other strategies. That the only problem with this here is this part, the unlimited risk. And it's not really unlimited, but for all practical purposes, it is unlimited, because the risk is the risk that the asset that you're going to trade is going to go to zero. Now, there's probably not a good chance of that happening. There's probably no chance of that happening, but it's still a significant risk, and it could wipe out your account for sure. So there's the most basic premium collection strategy. Now, there's a lot of other ways to collect premium and ways that you can reduce your risk. Like a lot of people put on credit spreads. Like a put credit spread would look something like this. It almost looks like the regular naked put, but not quite. It's basically two spreads. Let's say that you get in right there. And then with this, the premium part looks like this. Now, the nice thing about this is that it has limited risk. However, the amount that you have here is much less than just a naked put. Maybe instead of 500, it's only 200. However, now maybe you've reduced your risk to only 200 instead of being unlimited. All right, it's a better trade. You have a better risk to reward. In this case, your risk to reward is 1-to-1. So you have a 50-50 chance. The problem is that price needs to either stay here. It has to stay somewhere. Lost my color. Has to stay somewhere between here and here, or here if you want to get the maximum amount of profit. Here would be break even. But as soon as you get into that trade, if you start moving this way, you can see that that real-time profit line will affect you. So if you move and price goes down, even though you can potentially have profit if you wait until the end of the day, you have this to contend with, and the possibility of having a big loss. So that's the real problem with any of these type of trades. Now, a 1-to-1 risk to reward is pretty good. What most people put on is a higher probability there. Now, the probability of actually getting in profit here might only be maybe 55%. And that might not be enough for you. So what you'll do instead is something like this. You'll make that spread very high probability by putting it way deep in the money. And so it will look something like this. And then price will be right here. Because it has to travel a long way this way, there might be a 90% probability that you'll profit there. But now look at the difference. Your risk curve looks like this now. Now you have a long ways to go before you get to that break-even point. And maybe the chances are 90% that you won't get there. But now look at how big this risk is. Maybe it's 10 to 1. And as soon as you start, when you enter that trade, as soon as you start moving this way, you start going down. Even all the way to this point, that could, if you were willing to hold on, it could go all the way down here, but you might be down $800, but you're still saying, well, if I hold on and it stays right here, then it will make the full $100 I'm looking for. But is that what you want to do? Risk 800 or even 1,000 to make that 100? Now, if it goes this way, obviously, or stays right there, you're good. You're golden. So while a 90% probability of profit has its appeal, the amount of risk that you take for the amount of reward that you get may not be appealing. And in fact, during the entire trade, on 50% of your trades, you're going to be in this red zone. Let's see, we'll make it the red zone. Or you're going to go this way. That red zone's pretty ominous. All right. So here's another strategy that you can use. Something where you can take two flies or two spreads, like the put and the call, or put or call, and put them together into what's called the butterfly. And it looks like this. Should have made that black, huh? I'm doing this with my finger, by the way. Drawing with my finger. So you could go and put on a butterfly, and it might look something like this. I don't know if that came out very symmetrical, but let's do that over again. All right, that looks more symmetrical. All right, now the profit line looks like this at the beginning of the day when you first get in. Still has this problem. This now on a normal butterfly, if you put it on in the beginning of the day at the money, is going to range in terms of risk, but a typical one might be 3 to 1. So I don't really have this to scale, but 3 times profit to 1. Often it is 5. If you put it on later in the day, it could be as much as 8 to 1 or something. But earlier in the day, and if volatility is very high, which it isn't these days, it's very low, this strategy also is going to give you an okay risk to reward, limited risk, and much larger potential profit. But now you have a nice wide area that you can go between. But it's really not that wide. It's I would say that your probability of profit here might be 60 or 65%. But you have the potential to make a lot of money for the risk. Now, one way that we can improve this, and this is the flexibility of the butterfly, is to put it out of the money. And I'll show you what that looks like. We'll do this on a real chart just to see how things work. Maybe even take a trade today. Let's say that you're sitting right here. This is the money. If you put it way out here and you put the center strike right here, your fly is going to look like this. With a tiny little bit of risk and a huge amount of profit. Often 1 to 10. And then your profit curve will look like this in the beginning of the day. Now, at the end of the day, this profit curve is going to keep on growing until it looks like this, until it fills up what it looks like at expiration. So it really requires that, as a trader, you're going in the right direction, that it's going this way. But there's your risk. It's very tiny. And this profit curve is growing all the time. But here's the real key when you're getting into a trade these days. When you're in a very high volatility environment, when you start out with a trade, this profit curve that I have in cyan here, right there, is very flat. And it has a long ways to grow this way. But when you start out in today's environment, it's going to look a lot like this. Same curve. But it's going to look a lot like this. Like it's going to be preloaded with a lot of profit. So as you move this way, earlier in the day, you have like a head start at what's going on. So this is a high volatility environment. Whereas in a low volatility environment, it might look like this. So this has all kinds of implications about the width of the fly that you use, how far out of the money that you are, etc. Now I want to show you a chart on where we are today and show you what volatility looks like today. So to do that, I need to go to Trading View. And then this is a chart showing volatility over the past 2 years, year and a half, almost 2 years, year and a half. And you can see that it ranges, I have it all marked up, by the way, and the reason why I have it marked up is so that we can identify what we consider high, medium, low volatility. But one thing that you can see right away is where volatility is today. And that's way down here. Right there. Now you can clearly see that over the past year and a half, volatility is actually lower than it's been in a long time. Actually, you'd have to go back. If you looked at the lows here, let's draw a horizontal line so that you can really see just how low that is. I'll just plop a line in here on where we are right now. And you can see that you have to go back. Whoa, where are we going to go back to see this? You have to go back all the way to 2020 before you see volatility that low. Wow. Now, it stayed that low for a fair amount of time and even got lowered where we are for periods of that time between 2019 and 2020. Then, of course, here's the pandemic crash. And then we had lots of volatility up here. Now, when we were in this super low volatility regime, that's what we call when it's low, medium, high. We put the word regime on it because it sounds cool. When we were in this low volatility regime, we had a certain way that we traded, and that was generally directional because mostly the market was going straight up. I'll show you what the market looked like during that time, during 2019 and 2020. You can imagine with markets like that, it's going in one direction. So you can see very clearly that the market was just going up, 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 up with a few dips. Up, dip, 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 up, dip, up, 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 small dip, up, 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 up. And then after the pandemic, it was pretty much the same thing. We had the pandemic crash, and then again, up, dip, buy the dip, up, dip, buy the 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 dip, until we get to 2022, where the market was just so overpriced, overvalued, that it couldn't take it anymore. Now, when it first came down in the beginning of 2022, we thought, oh, it's another buy the dip moment, until it just kept on going down. And then it finally came up, and then it kept on going down. Then it came up, then it kept on going down, and it just kept on going lower and lower and lower. Right? Till we ended up at the very lows in 2022 of October. And then it finally started to do a reprieve. We started consolidating, and now we're in this melt up. It looks like we're getting into the same exact thing that we were into way back here, only it's worse. Or I should say better. It depends on how you look at it. Volatility is really low again, like it was way back here. And way, way, way back here. Volatility was super low back here. So that means that we have to sort of adjust the way we're trading, and that leads me to why we trade the butterfly. The butterfly is a super adaptable strategy. And what I mean by that is that we can change the ways that we trade it by just varying a few little parameters. And we don't have to change the fundamental part of the butterfly. It's still the same thing. The difference is that we can trade it the same, essentially the same, all the time in all different market conditions, and always be collecting premium. Now, if you watched yesterday's show, I explained why you would be wanting to buy premium, and I talked a little bit about it earlier today, that we want to be on the buying or selling a premium is the best way to put it. We want to collect premium. All right, we want to collect premium because that kind of takes away some of the price movement from us and allows us to concentrate more on that collection of premium. And we have that incentive to do it in 0 DTE because it is decaying at its fastest rate in the shortest amount of time. So in other words, we can collect it at a time when it's collectible at the fastest rate in the shortest amount of time. And that butterfly gives us that ability. Yesterday, I talked about why it was really in our advantage to trade a small risk, high potential profit trade, as opposed to taking a high probability trade. That there's no scaling in the high probability trade. There's huge scaling in the low probability, low risk, high potential trade. There's also scalability in terms of being able to make your account bigger and bigger. The other thing that these types of trades do for you is allow you to have very small drawdowns. All of these are great things to have. So we combine the asymmetric trade, small risk, large potential profit, with premium collection. That's in the butterfly. That butterfly, we can adapt it to just about any market condition simply by changing its width or changing its position back and forth to the market. And there are some small, characteristics that we have to keep track of that maybe slightly alter our approach, but it's still the same thing. We don't have to resort to a completely different strategy because the market has changed. And that's the one great thing about this. The market is always changing. In fact, if there's one thing that I can say that is consistent or constant with the market, is that it is constantly changing. Now, our service and what we do here at 0 DTE is really attacking that one problem. How can you master a constantly changing market? In fact, the logo up here, which represents a Zen circle, right? That represents a term or if you were to ask somebody, that means impermanence. Impermanence is just another way to say that things are constantly changing, and we manage that by putting on a process that is cyclical in nature, that is constantly measuring where we are, what we're doing, and then making improvements along the way, breaking the problem down into these tiny little iterations, and then attacking each little iteration with great strength, because we're doing the same thing over and over and again. We're not trying to figure out, where's the market now? How do we act now? What do we do now? Oh, we have all this large risk ahead of us, or now we only have a little risk. We never have that. We always keep the exact same thing. Always small risk, large potential profit, same strategy. We just have to make minor adjustments in terms of its width and how we approach that. And it works across the board. It is now we don't have to worry about the strategy itself. We only have to worry about our process, and that we're doing the same thing over and over and over and over again. And there's a lot of different ways to trade the butterfly too. We could trade it this asymmetric way, which is by far the most advantageous way, and that's to push it out and turn it into this directional trade. We can turn it into a market agnostic trade, where we can put it on both sides of the market and trade it so that whether the market goes up or it goes down, it goes towards our fly. So now we play both directions. Of course, that leaves the middle, and that's something that we deal with. We could also trade it so that it's directly above us, which I think is the least desirable way, and that's the way a lot of people actually trade it for some reason, the least desirable way. We can also look at the butterfly and look at its cousin, the iron condor, which is a little bit different. The iron condor looks at a butterfly but kind of stretches it out. And it has some neat features to it, but it's not ideal. All right, we'll talk about that at some other time when we get into the iron condor, and we'll discuss what you can and can't do with the iron condor and why the butterfly is far more flexible. So Greg is asking, so the butterfly essentially does both collect premium and have some kind of directional bias. Yeah, it has a directional bias, and it allows you to control your risk. You can control your risk based on how directional you want to be. And people will think, well, if it's directional, and if it doesn't reach the fly, do I make money? The answer is you can. It depends on what your objective is. Do you think that you have to stay in the fly until the end of the day? In other words, does it have to get all the way over there and then expire inside of that fly to make money? That's not true. So let's go over something like that. So we'll start with what this looks like to the trader. When you put on a directional fly, you're putting it on out of the money. You're starting here at the money. Its center strike is way over here. And then the real-time profit curve is what you're really interested in. Most people kind of lose track of that. They think that this is what we're playing to, this at expiration, but it really isn't. It's really the real-time profit curve that kind of looks like this. That's the only thing that you really care about. Now, here's the cool part. If you get a small directional move, maybe to here. Now, if we take a look at where that lies right here on the plus minus, you'll see that you don't have to go too far towards the fly. You don't have to get in it to make money. As a matter of fact, you can make money anywhere from here, 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 anywhere. Even if you go beyond the fly, you can still make money because this is all in profit too. Now, as the fly goes on and time goes on during the day, this this is your premium aspect of the fly. That premium is rising inside the tent and kind of going down this way, but also going this way at the same time. So it's doing this, right? So if you move early on during the day, you're going to be in this area making money. And in fact, you can make substantial money even being still outside of the profit tent. In fact, most of our trades are made outside of the fly. About 75% of them have returns on the risk that we take. Let's say that the risk is 100. Most of our trades will make anywhere from $25 to $150 on that $100 that we risk. And they never get inside of here. Never. And they're quick trades, they're usually in and out. Now, if price keeps on moving and then happens to get inside of our fly, now here's where we can make a lot of money. If we're in the first third of that fly, we make anywhere from 150% to 300% on our fly. And if we're very lucky, now that happens about 20% of the time. 20% of our wins, I should say. So 75% of the time that of our wins, we're making 25 to 150%. 20% of the time, we're making this much. About 5% of the time, when we're sitting right in the center, or very close to the center, we're making anywhere from 300 to 1,000%. Now, that's a low probability thing. It is probable, though, and it will happen. Like today, for instance. Let me show you something. I need to bring it up for you. And it's a little bit different right now at the moment, but that's okay. You can see exactly where it was. All right, we can see right now, this is a trade that was taken earlier today. Now, for the longest time, over the past couple of hours, it was sitting right in the middle. It was sitting right there. And just recently, it moved all the way over to here. Now, I want to show you what that profit is right now. That profit is about $1,000, and the risk was 500. So if you took the trade off right now, that would be about a 200. Well, in this case, it would be 100% return. No, actually, it's 200%. So you're making 2 for every 1 that you lose. So that's 200% return right there. If you were to get out right now. Now, just a few moments ago, it was sitting here at $2,500. You would have made a 2,400%, let's see, no, about a 500% return right there. And of course, we would have gotten out before it moved all the way over here based on our strategy, but that's where it was sitting. So there's a 500% return right there. Now, if it ends up, that price moves down and ends up right here, right in the center, there's the possibility of making as much as $4,500 off that original $500 risk. But this is where it's sitting right now at about, well, now at about $825 or $800, right around there. So how did that market move today? You can see here, here's the market when it was here. That's where it was, right in the center of the fly. Now it's moved off of it a little bit. Now we're over here. There's a possibility we might move up into the center again. So there's a real life example of how this trade would work. Now you can see that if you entered it from this side, you could be outside of the fly and still make a 200% return. And while I said that, typically we make between 25 and 150% outside of the fly, there are cases sometimes where you can make 200, 300% and still be outside of the fly. So JMO is saying if it moved against you, you just close and take your loss. Yes, that's exactly right. So we have a framework that we use that we chop up this problem, because if you look at this problem, it's really a two-dimensional problem. It's a dimension of time, where you are during the day, and also where you are relative to your strategy. So price is constantly moving back and forth. Now it started way out here, and then it moved all the way in right to the center, and then it moved back, and then it's moving up again. Right? Now it could move all the way back to the center, and if you were to hold on to it, you would make a lot more money, because there's still another $2,000 of profit potential left in this trade, which is pretty crazy. So that two-dimensional framework is what we use to manage our trade. And it goes something like this. So you're going to get some first-class education here on how to manage a fly. We'll go to like this, and this is how we look at it. So we'll make a matrix. We'll say, okay, we want to divide the day up. First of all, let's take a look at premium and the way it behaves over the course of a day. Let's say that this is the open, and then this is the close. What we do is we split up the day into 3 segments. And those segments get progressively smaller because to represent the decay that happens in the market. So the first segment we would call the morning session. The second segment we would call the afternoon session. And then the third segment we would call the closing session. All right? Now, if we were to take a look at the premium that we're trying to collect in that fly, how it behaves, how fast it is going, in the first part of the day, it's kind of doing this. The second part, it's starting to dogleg, and the third part, it does this. So now you can see why we split this up into 3 segments, morning, afternoon, and closing, because the rate of decay is unique in each one of these segments. Here it's flat, here it's doglegging, and here it's falling off of a cliff. So that means that we have to have 3 different ways that we would or adjust our attitude to price. More specifically, because of the rate of decay here, it basically means that we need to become more sensitive to price movement as we get closer and closer to expiration, or tighter with our hold or fold decisions. So that's the first dimension, is time. The second dimension is where we are. So if we were to take that that risk graph again, we break this problem up into 3 segments. Let's say that this is where we start. We break it up into 3 segments, and we go by the break-evens. We have one break even here and another one here and another one way out here. And so if we were to draw lines going straight up, we could say, okay, we have three different areas. We have zone 1, zone 2, and zone 3. Now, zone 1 and zone 2 are going to vary because over time, this zone 2 is going to close up as premium decays. So now this will be the new zone 2. But it's still zone 2. And it's a way for us to identify where our trade is. So how we treat things in zone 1 or zone 2 or zone 3 are also going to be slightly different depending on what time of the day it is. So now we have this kind of matrix. We have the morning, afternoon, close, zone 1, zone 2, zone 3. And then we just make decisions in each one of these places. How do we act? Well, in zone 1, there's not a whole lot to do. But these decisions that we're making here are buy and hold decisions. So for instance, right now, we are in the closing session and we're in zone 3. Do we buy or hold? And we ask that same thing in all of these. Now, usually that decision making is going to have some sort of criteria around it. Like, so for instance, we will decide what our tolerance is. Do we have a 25% tolerance of whatever high point that we've reached? Do we have a 50% tolerance, 100% tolerance, 10% tolerance? Typically, when we're in here, when we're in this closing zone 3 here, we have the least amount of tolerance. So we might have, I don't know, 15 to 20% tolerance. So what does that mean? That means that if we were in this trade, and we're sitting right here at the center strike, and we have $2,900 of profit, and our tolerance is only 15%. Well, now it's at $3,000 of profit. Let's take $3,000 and multiply it by 15%. What do you get? You get $450. So that means that we would get out as soon as price moved over to the point where we had to give up $450. So as soon as it moved to here, we would have been out. Now it's moving all over the place because we're getting near the end of the market and volatility is going nuts. So instead of taking home $3,000, we would take home $2,550 if it moved out here. Now, if we waited all the way out to here, then we're giving up about 70%. We wouldn't do that. So when we're getting late in the day, our tolerance is very little. When it's very early in the day, our tolerance is much wider. And that width will always allow us to give it enough room to grow, but not enough that we would lose money or significant money. And you want to give it that room to grow because the more room you get it to grow, the more chances are that you'll get into or close to this profit tent if that's where the market wants to go that day. Well, you know, there's a very good point that that Deathly Gaming is making. He says, Ernie's trades are good. You just have to take the time to get hands-on to learn it. That's a fantastic point. Let's think of it this way. If you're coming into my service, you're coming into it because you want to learn how to be consistently profitable, become an independent trader, and trade at a professional level. I take those three things extremely seriously and literally. If you want to become a professional, what do you have to do in any other vocation that you ever get into? You have to go through years of training and education and experience before you can consider yourself truly professional and at the top of your craft, right? There's no difference here. The difference, well, there's no difference in this type of trading, but the difference here is that you're going to get first-class education and coaching and a top-rate program that's going to help you accelerate that learning and that experience and keep you on track, then show you how you're going to embed that learning, become skillful, get the muscle memory, so that it's something that will eventually make you completely independent of any other people, that you can do this on your own. And that you will be consistently profitable, meaning that you will have the ability to use a very sophisticated process that will allow you to adapt to any market condition. So you won't have the fear of getting into a violent market or a overhyped market or even an extreme low volatility market. You'll know exactly how to handle it because you will have experienced it, and you will know exactly what to do at every moment. And you will know how to break down the problem into this sort of dimensional framework, and you will have already traded dozens of trades within each one of those dimensions. And you will have developed the experience about what's the best possible thing to do in each of those cases under different underlying market conditions. And as you go further on into your career, you will have that level of certainty and that ability to slice and dice that market up and be able to concentrate on those areas and improve the way you attack that market and only get better, only develop a higher level of consistency, a higher level of independence, and a higher level of professionalism. That's exactly what this service is all about. Right? It does take time. In the same way it takes time to join a company, get in at the ground floor, learn the operations, start learning all the nuances. And of course, you have the education. Maybe you go through continuing education and you experience a whole bunch of different things. You move on from one department to another. You start learning the whole breadth of the company. It's really no different. The big difference here in terms of your ascension through your the professional level, the big difference here is that you're not doing it on your own. You're not trying to discover all this stuff on your own. Would you have known that an out-of-the-money butterfly is the best way to control your risk and maximize your potential profit? Would you have known that most professional traders actually use that precise strategy on the trading floors when they're trying to collect premium? Would you know the techniques that they're using? No, you wouldn't. You wouldn't find out these things on your own. You find them out because you're in this service, 100%. If you want to join this service, go down below, take a 4-week trial. We make it so easy for you. It's a 4-week trial, small amount of money to pay each week. In that 4 weeks, you're going to learn more about options trading than you ever thought possible. You're going to learn more about options trading that makes money on a consistent basis that you ever thought possible, that you will never see out in the retail world. You'll be coddled, handheld, but at the same time, given enough leeway so that you will learn this on your own. You're going to learn from somebody who's been there, that has been a professional trader, a hedge fund manager, an institutional trader, that has also trained and coached professional traders on the exchange floors, that has actually built the systems of Wall Street, literally built out Wall Street. My team has literally built out Wall Street. When I was with Sun Microsystems as a chief architect, we literally built out Wall Street. The systems, the software, everything for the exchanges, for the prop trading houses, the investment firms, the brokerages, the hardware, the software. So not only do I have an innate understanding of the market from a technical level, but also as a trader, someone who's traded hundreds of millions of dollars, someone who has coached people that have traded that kind of money and got peak performance out of them. You'll get all of that for really what is a ridiculously low price. And I'm doing this because that's what I enjoy doing. I enjoy helping people achieve peak performance. At first, these strategies, they might seem like a lot for you to learn. But it's nothing that you can't pick up very quickly and then understand what the basics are and then get on a path to breaking that down into its components and getting better at it every day. Let's see, I'm going to read some of the comments here. Looks like there's been a nice little conversation going on where Deathly Gaming is the center of attention. Yeah. You know, if market internals help you, that's fine, but I don't think it's really necessary, to tell you the truth. A lot of times people, you know, at first they don't get it. They don't understand what it actually takes to learn a system like this. And the one area that I think that most retail traders fall flat on is that they don't give any strategy enough time because they don't have a process for being able to apply themselves. And that's the one thing that pros do have. The other thing that pros have is they have a coach that, and just like any organization that has peak performers, is there to help keep you accountable to that study and that application of that skill. So if you don't have that, then that allows you to sort of flail all over the place, trying different things, hoping that you're going to find the right thing. The other thing they don't have is the built-up knowledge that has gotten pros to become extremely successful and show you the path. We leave a wide enough path so that you can find your own way. The other thing is virtually all retail traders don't do is they don't keep good logs, and they don't know how to journal. And they don't know, if they are going to keep good logs and journal, what to do with that information that allows them to get on that continuous improvement path. That's huge. All right. We're just about at the market close. Where is this strategy? Let's see where it ends up. So if you held this right into the close, you would have made $2,200, no, about $2,000. Looks like it would have crossed right there, $1,872. Now, of course, you could have got out when it was peaked in here and made quite a bit more than that. So Clay says, this is the fourth day using your Batman fly and so far 4 losers. But why? Why? This market moves so much. If you didn't win, then you're absolutely doing something wrong. No two ways about it. Are you using the profit management framework? If you were, there's absolutely no way that you could have lost today. So that's, you know, I don't know what to say about that. And yesterday was the same case. We had such a large move. If you were using a Batman, again, another day where there's just simply no way. So you may be using what you think is the Batman, but are you a member of this service, and are you actually following the process? Because if you were, these last 2 days were huge winners. All right. See, that's, if you're out there doing it on your own, it's kind of tough to know, are you making the right moves? Is this the right thing to do? Is this the framework I should be using? See, okay, you're not a member. So you weren't using my Batman strategy at all because you have absolutely no idea how to use it. If you did, I guarantee you would have made money both of these days. Not just a little bit of money, but tremendous money. The other thing is that you probably wouldn't have used the Batman strategy today either. And you would have used just a single fly. Right? Well, that all sounds good, Clay. Then how come it didn't? It had to have gotten into profit. There's no way it couldn't have got into profit. So how do you explain that you let it go and allow it to become a loss? That doesn't make any sense. It's either that or you get out too early for whatever reason. All right. You should join the service, Clay. Join the service, learn how to do it. First of all, I would have recommended not doing the Batman today or yesterday or any time during this low volatility regime. The Batman has its place, but in super low volatility, that isn't it. Still don't understand, because I had a 50 wide fly on and it went all the way to the center strike. Good, glad to hear it. Give it a try. And the risk is super low. You don't even have to trade real money, right? Get in there, give it a shot, follow along, and if you think it's something that will improve your trading, then sign up for the year, which is also very reasonably priced. All right, guys. Thank you very much. 2 big days. That might be. You could be entering at the wrong time, but still, understanding, why you're entering at a particular time or not is part of the game as well. Because there are some times that you want to enter later, sometimes earlier. All right. Let's go back to the big head. And I want to thank everybody very much for showing up. Peace to you all. We'll see you tomorrow on the next edition of the Final Hour Show. We're going to start getting into individual trades and start exploring taking some of these strategies. We'll also explore 1 DTE trades. What it would appear to be 1 DTE. They're technically 0 DTE, but taken outside of markets, outside of the normal market time. All right. Peace. Music. See you tomorrow.